Hi, I'm Keith McCullough, and welcome to what is now actually the 9th investing summit. It's been a while. It's been a while. My hair is going white. We're in the throat of a bear market, and we're going to have some real conversations that you won't see anywhere else right here and now. It's going to be my pleasure to introduce somebody who I've never met in person or had a conversation with, obviously, and that's kind of how I like to do it. But again, I was trying to find somebody who is certainly as bearish or more bearish than I am, and I think that that's the appropriate way to kick off the investing summit, because you won't see that amongst or amidst all the bullshit on TV. You're not going to see people actually break down a bear market. So, Hugh Hendry, welcome. Thanks for making the time.
Keith, an absolute pleasure, but I have to warn you about that old saying: never share a stage with cats, animals, pets, kids, and Hendry. So beware.
Well, you're off the island. You're in part of civilization, aren't you, Hugh? You all right?
There's a big question mark as to whether it's civilization. I've just checked into a somewhat salubrious hotel in the West End of London, the kind of place that I fear that illicit encounters perhaps go on. But anyway, let's be illicit and let's call this market for what it is. It's going down.
Yeah, well, I mean, that's, I think you said that it could be worse than '08. You know, I get a lot of people, institutional clients in particular, that are back and forth. This isn't '08. Of course it's not '08. It's 2022. So why did you say that?
Indeed. So let me first of all push back against it, because I've been having some really informed conversations with the plumbers in the market, the guys in the volatility pits, the mathematicians, the geniuses of this world. And it does look, with the bond market and with the curvature of the yields, the yield curve, this is the most predictable big recession ever. Like for the last over a year, everyone's been going, Fed, what are you doing? This is going to be a disaster. And you can actually see that people have kind of become a little bit, they're fed up with volatility. Buying volatility has failed. And so people have been reducing risk, like Delta One. They've been just reducing absolute levels of risk. So it's a known entity. It's going to get bad. It's going to get real bad. In terms of my misgivings, it's just the cumulative effect of all the things that are going wrong. And it's my fear that it may bring in the Chinese with regard to their exchange rate policy. And I'm very fearful that, just like in 2015, the debate might turn to a deval to the 9 level. What two motivations there? Aesop's fables. Why did the scorpion sting the frog halfway across the river? Because he was born like that. Why did Taiwan devalue its currency in 1998? It didn't have to, but when every other mercantilist Asian nation was doing it, then, it was born that way. So I fear that China is born that way. And secondly, how else do you address the $90 trillion high tick on residential and commercial property in China without having some assistance from a dollar devaluation? I hope not, because it would be the most profoundly deflation event ever. But those are some of my concerns.
Well, that, assuming people understand why that would be critically new and omnipotent in terms of not just disinflation but deflation, is through the lens of a dollar move that the world's never really seen. I mean, that's something. I mean, as you know, they have a closed capital account, so they've been able to kind of drip. But why is it that you think that they're going to behave like every other EM in the history of emerging markets in terms of that kind of a deval?
Well, I question whether they would be allowed to. I mean, their trade surplus with the rest of the world is over 1%. And people kind of shrug and sigh and say, really, 1%? But like 1% is enormous. And the Fed in its quantitative easing program gets all the blame for the liquidity, and supposedly it's the quantitative easing program which has bid risk asset prices to infinity. and we're now trying to address the kind of fictitious wealth that's being created by heady or misplaced optimistic expectations. I'm somewhat different. I believe that when we go back to, and I must take like the fish out of my throat when I say this, the Nobel economist Bernanke. I mean, really. But when he was authoring or sponsoring the thesis on the glut of savings, really he was talking about the mercantilist policies pursued via the fixed exchange rate or the management of that dirty float with the Chinese renminbi versus the US dollar. And we've had upwards of $7 trillion deposited in US sovereign treasury bills. And when a nation like the US runs a deficit, a trade deficit, but at the same time, it doesn't have a scarcity, a shortage of domestic savings, then what happens is what we've seen the last 15 years. There's an enormous tsunami of liquidity that comes in from mercantilist nations. It gets dumped in the US. There's no need for those savings to finance investment, and therefore investment becomes speculative. And we've turned the US from a profoundly entrepreneurial society into a profoundly speculative society. So some might quibble about it, but to I put the blame on asset values, the elevation, the 1%. I put it on the Chinese, not the Federal Reserve.
But you're still at the same time very critical of all of it. I mean, central banking. I have a good tweet that you had. You said the other day, actually it was September the 28th, you had a tweet that says, "Today feels like a moment. The central banks are being stripped of their dishonesty. Their omnipotent propaganda increasingly called into question. The Westphalian conception of money is crumbling. Trust the Brits to let the cat out of the bag. Just why do we need central banks?" And yeah, I assume that's all encompassing, BOE to the ECB and back again to the Fed.
Oh, absolutely. So the UK has found itself at the center of the storm. There's nothing idiosyncratic or special needs with regard to the UK. It's not back in the day when what's his face, the famous bond investor, forgive me, when he said sterling was like nitroglycerin and it's going to blow up, and I think yields were 5 and they ultimately went to like below 1%. So I think his reputation blew up. That's why I can't remember. I'm doing him the great justice of forgetting his name, but I don't
He's just another Bond king that's lost his throne.
Exactly, he lost his mojo. But I don't see sterling or the UK fiscal position being like glycerine. The debate about their tax cut again just reveals the profound blindness of the governing elite. Here was a Western government whose sovereign debt to GDP was not an outlier, was not contentious. Its peer group, they're all kind of high historic levels, but it was within that peer group. It is stagnating. Its central bank is, like other central banks, is confusing a political with a monetary phenomenon and is using the wrong policy tool. So a stagnating economy, which is now under the knife of high interest rates, at the same time as we have this energy crisis, and the government proposes stimulus. Oh my God! So I quibble with that. But the thrust of why that day felt different was that the Bank of England was pursuing rate hikes, which I disagree with, and at the same time quantitative tightening. And it's all quantitative theater. It's a quantity theory of insanity. That's what it's better referred to. But the jargon is that tightening is like a rate hike, and so it's all their policy is consistent. And then one day they have to come out and say, we said we were doing quantitative tightening. No, we've changed our mind. Now we're going to buy. And it's like, well, guys, make up your mind. You're losing your policy discretion. You're losing your ability to fool everyone all of the time. And what's really happening is the encroachment of the euro dollar, this dark web of unregulated overseas banks who have effectively or allow infinite leverage, and where the system is disciplined by your reputation with your counterparty. Mm-hmm. And what we're beginning to see is that sterling gilt bonds are no longer being accepted as robust, safe collateral, and it's being called in, and therefore the Bank of England's having to buy it back. I don't think that will be. I don't think that'll be restricted to the UK. I think it's already happening. Collateral in the Eurodollar system likes liquidity. Gilts are kind of liquid, but the elephant in the room in terms of worry knots would be the Italian 10-year sovereigns, colloquially the BTPs. I think it's either the third or the fourth most liquid government sovereign bond market in the world, and I fear there's a profound amount of collateral vested on that. And one of the reasons you're seeing dollar or pushing the euro below parity, I think, is an unwind where counterparties are insisting on dollar bills, and therefore their clients are having to sell Italian euro priced BTPs. So there's a lot going on.
This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today, trying to give you all the content so that you can see that there are many tools in the toolbox to play at the highest level. Leadership matters at Hedgeye, so again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probabilities. It's not about picking stocks. It's about picking the right portfolio. Execute across everything. Don't get distracted by the MSM and the tourists. They're very dangerous. I will grind and execute for you with our people and with you. There's a lot going on, and you've always been very consistent in saying that these, I think, and correct me if I'm wrong, but you'll say profound market risk turning points are all about collateral. Can you expand on that or explain to people what you mean by that on the crashes linking to collateral?
I think that's thank you. That's an excellent point, because 2008 was 100% collateral.
Right.
JP Morgan had become the kind of the central warehousing of the universe of collateral, and there was a day when JP Morgan went,
no bueno.
no. There's this thing, Gresham's law, that bad money drives out good money. Back in the day of kings and queens, they would call in the coinage, the gold coinage, and they'd put a little bit of kind of metal in there, so bad money driving out good money. And you see that in collateral, because it should be the most liquid and the least risky, i.e. it should be US Treasury bills. But then bankers kind of get a little bit optimistic and they start accepting garbage, and as long as it's liquid. And back in that period leading into 2008, they had been accepting, the mortgage-backed securities. There was a conceit that somehow a diversified portfolio, a certificate of diversified US mortgages, was somehow less risky than US Treasury bonds. And so that was a large component of collateral. And in the summer of 2008, the late summer, JP Morgan started demanding that was unwound, and that completely, and it really unwound. Now, like I say, as bad as 2008, one of the plus points really has been that the government has replaced the JP Morgan role of the central warehouse, and therefore they'll play all the games with swap lines, etc. This time around, the government is going to be bailing rather than allowing the bankruptcy of institutions like Lehman's. But you're still dependent on them being wise. You're still dependent on them understanding money. And that's what I get increasingly concerned.
Well, the volatility of assets. I mean, when you think of, let's just use, I don't know how much work you've done on the CLO market, but if you think of Credit Suisse's real big problems and the tying it back to the UK and the pensions and the volatility that they didn't know that they had. It's supposed to be, like you said, a safe, liquid, position, but that's, to the contrary. Obviously, the BOE panicked, partly because of that. Is that not correct? I mean, you basically had them shit their pants because it's one thing to fool, like you said, some of the people some of the time, or all the people all the time, but once you start to fuck with people's pensions, I mean, My father's an Irishman with a pension. You want to really piss him off? There's a lot of things that you could do, but just take his pension.
Yeah. Well, again, there's a degree of subterfuge, really just from the ignorance of financial journalism, where again, the debate is all about the fiscal policy, right or wrong. And no one's discussing the insanity that has infected the austere, supposedly the austere committees of British pension funds. And we've discovered that they're leveraged up the wazami. They're leveraged to insane levels. And the journalists, no one's even thought to say, dear Mr. Pension Fund, could you reveal what your leverage is? And could you tell us why? Have you lost all sense? And of course, I mean, they were compromised because we live in a world where, so it particularly affects, I think it's called defined benefit schemes in the UK, where you're actually committed to a particular payout. The risk is on you as the fund. And these things are unfunded. And so they just take you. If you're bankrupt, it's all about trying to be staving it off for another day. And you take huge casino-like bets. So, yeah, I mean, yeah, it's UK. I mean, let's think about it. UK British government bonds have gone from yielding 1% to yielding intraday this year 7%. On one day, there was no bid, and before the intervention of the central bank, gilt prices almost halved. Now, that's the safest asset. And so if I was sitting there looking at my portfolio of small cap Russell 2000 stocks, whatever, Chinese stocks, can you imagine Chinese stocks? I would be like, what am I doing? I mean, the most contentious thing you can say is panic, people, panic, sell everything. Experts won't tell you that because they are vested in the status quo and they would rather that you're taking those blue pills and you're blissfully unaware.
Blue pills. I mean, that would be being polite. I mean, so you're going to, but it's all in the great noble fight against what they had no idea about, which is inflation. So I'm going to fight inflation, but I'm going to burn down every component of capital markets that me, the Nobel laureate, just received laureates for. That's the market that they all signed off on. This is the structure, whether you agree with it or not. I know you and I don't agree with it, but that's what you have. So we're going to burn that down. We're going to burn your pension down, and we'll have solved for inflation.
There's going to be a revolution. I mean, that's why I'm on my little private island normally.
I don't blame you. I just built a house on an island myself. I'm about to get the fuck out of here. It's like, it's crazy, man.
It is so crazy. But and again, I forgive me. It sounds as if I'm really anti-Chinese. I am really anti the Chinese Communist Party. I mean, they're jackboot fascists. I'm anti that. I love Chinese citizens. I would love their liberation. But what's happening again is that for the last 30 odd years, we've had a trade issue with China, which is really a class warfare. It's class warfare. You get it in the ass, forgive my crude language, if you are the ordinary citizen, because all of the transition pain is subject to you, right? And now, and this is why the Fed keeps talking about the labor market. It's like, you guys are idiots. Who cares about the labor market when there's 1.4 billion Chinese and there's a dirty fixed exchange rate, right? Stop talking about the damn labor market, right? But we've got this class warfare on the ordinary folk, and now the Fed's joined in and has got your mortgage rate at 7%. Those two things are going to break the political economy. We're giving Nobel Prizes to these idiots, and they're doing it again. Where is their lucidity? Where is their comprehension? And forgive me, Keith, but I would push back. I do not believe that we are seeing the emergence of a 1970s inflation. I think we have seen the markets, the private market economy had to respond to the waves of policy checks, to American households when the industrial world was shuttered with the pandemic, which is to say there was no supply. And so there was a profound displacement between supply and demand. And in that environment, markets price higher to bring supply and demand together. The question is, will that be a permanent acceleration? And for me, I maintain you'd have to see very bullish banks actually lending money into the real economy as opposed to their past, which has been lending speculatively into private equity and stock markets. That the mainstay of credit creation for the last 15 years is now collapsing, which is to say that form of monetary creation is money's being destroyed. And it's not being replaced by borrowing or lending by the banking community. So to my mind, if inflation is a monetary phenomenon, then the monetary phenomenon is reversing.
Right.
And therefore, within 2 years, you will see a profound normalize. I hate to use this word normalization. You'll see lower price hikes within daily life.
Yeah, I agree with you on that. It's interesting that so many people are fascinated. Obviously, the Fed is the last to figure it out on inflation. And to your point, like late cycle employment, he was talking about the freaking beverage curve at one point. Like Powell, really, the beverage curve. What the slide 95, guys, just to remind people, how late cycle of a lagging indicator that is. I mean, I'm showing back in the 1970s and again pre-1980. Labor goes away immediately when you're in a recession. So that the lights are already going off on them. People are going to lose their job. They're losing, in some countries, large chunks of their pensions at a clip. It's no different in Canada, by the way, than it is in the UK, because you have people in same thing, defined benefits plans where contributions are what they are. They put you in a pie chart. All of a sudden, you got interest rate risk. You didn't know that. You own CLOs. You didn't know that. To your point, you have asset allocations to things that you can't even believe. But my main question here is, if you burn the capital markets, you crush their pension, and you take whoever's working, you take their job. I mean, is that enough? Finally, because I've been a critic of central banks for a long time, but I've been tasked with trying to front run this damn game all the time of when the Fed gets to be almighty again and pivot. It's like, why don't we just? Is this the time where all, I guess Neil Howe, our in-house demographer, and you probably know who he is, who wrote The Fourth Turning, is this all part of that? That the central banks, as the establishment's almighty institution, are actually going to go, they're just going to go away in terms of how they're currently constituted and how their far-reaching powers?
The heavens, a lot there. Specifically with the U.S. Fed, there's a great Ayn Rand quote I'm struggling with. Something like, the man who's responsible for one lie is a slave for the rest of his life, something like that. And Jay is responsible for like an astonishing lie, which came under duress through very challenging circumstances of the pandemic. And he found himself, or he willingly participated on daytime American television, which is not normally where you find the Federal Reserve Chairman. He took his tie off, and he was sitting in the parlor room of the American household saying, "I'm from the Fed, and I got your back. I'm printing money." And they said, "I'm sorry, Chairman Powell, but could you repeat that? You're printing money?" Yeah, no, we are printing money to ensure that the American population will persist. We'll get through this crisis. Now, there's this thing called federal law, the Federal Reserve Law, I think of 34 or 1935. I mean, if he was printing money, he would have to be incarcerated, or we'd have to do something. There would be legal means that we'd have to take upon him. They're not allowed to print money. They haven't been printing money. It's part of the Wizard of Oz and the almighty magnificence, the omnipotence of a Federal Reserve that happened to preside over 2.8% average GDP in the 30 years up until 2007, 2008. They could do anything. They could get it all wrong. They could be like blind rats, just stumble from one crisis to another. But such was, to your fourth turning point, such was the momentum within the progression of our wonderful economies that we could deal with it Today we can't. The compound growth rate since the great financial crisis is something like 1.7. We've really come down. Prosperity is not being, we're not accumulating it the way we had, and we're not sharing it the way we had. And then you do get this spike in prices, and it's like, well, Jay, you told us you were printing money. This is on you. And now he's out kind of going, well, what do I do? Like, well, let's raise interest rates. And like we discussed, yeah, that's really going to help. That's really going to bring the oil price down, food pricing down. It's really going to sort out the Ukraine-Russian thing. It's really going to make people invest in nuclear power plants with a 30-year time lag.
So if and when he does, and this is the worst part of my job, I genuinely hate it. I love the game. I love trading markets, any market. I'll trade anything, and I love it. But I hate that the next part of the game, every single person who's underwater, you have multiple hedge funds now that are down 30, going on down 50 if they bought the recent bounce that they thought was going to be, something bigger. Everyone needs the Fed pivot. And in a way, you and I are saying they shouldn't have been raising rates into what I call a quad 4 global recession or a quad 4 slowdown anyway. So we're saying you shouldn't be doing that, so stop doing that. But then on the other side, go back to doing what created this entire insanity of it all over again, which is the definition of insanity.
Yeah, but it does feel that the man who lies becomes the slave. Yeah, he's no longer the master; he's the slave. So the master could do the pivot and go, hey, we have to underwrite the banking system. We can't allow it to go to zero. But now he's a slave. He's a slave to, he was printing money. We've got inflation. So, I mean, what's going to happen? This, Keith, is the market. The market fell 20% in 2019. I get these years mixed up. They all roll together. 18 or 19. 19, I think. Jay was hiking rates, and the market took us down quite promptly. We went 20.
Q4 of 2018. He basically tightened into the peak of the economic cycle, which is why we say you tighten into a slowdown, you're going to turn tail dovish, which he did by Christmas time.
So the market went 20%. Hello, and the Fed went The market's tried it this time. We've been down 25, nothing. So, the market's going to go, okay, 30%, 40%, 50. I mean, the market's just going to keep knocking on the door, and there will be a level, and there will be a pivot. But is it a pivot that allows a new all-time high in equity markets? Kind of, that's feeling harder. The reference point with the 70s that seems to be more apropos would be that 1968 to 1982 profoundly cruel trading range where the market breaks out and the pension funds buy, and then it goes boom down, and then it's like cratering and they sell and it goes up, and it did that torture for 16 years. Who knows? Every cycle has its own idiosyncratic pleasures and pains, and I think this will be no different. But in terms of turning points, so I'm doing a lot of Buddhist reflection. I've had a profound understanding this year or teaching in terms of the impermanence of life. And as investors, one of the thing you've got to take on board is that nothing lasts forever. And as much as I would fight the inflation argument, I do believe that the US Treasury bond market, the greatest bull market in the history of mankind, it is not a permanent state of affairs, and it will end. And I think it is ending, but I think the end will be characterized by absurdity. And so I still believe such are the horrors of the economic wounds that I see the Fed inflicting upon the political and the real economy. I'm willing to argue that Treasury bond yields actually might go back to COVID levels. And that would be absurd. But the Fed was at what, 20% rates in 1982. The bond market, yeah, it inverted the curve, but 10-year was 16 plus. And anyone that had a pulse and was alive could clearly see that inflation was collapsing, and yet we still had that pricing. Yep. So absurdity shaped and formed the beginning of this monumental bull market. And I'm willing to suggest to you that absurdity will define the end of it. And how could Treasury yields trade at COVID levels? Well, we began this conversation by speculating that we could see a deval in the Chinese renminbi. That would have 10-year Treasuries back on the low yields.
Yeah, and that would be that would be what I call a proper quad four. Quad four is when the rate of change of growth and inflation is collapsing at the same time. All right. What you have currently is more like a stagflating quad four, where the inflation is dripping and it's eventually going to collapse. But the dripping into the Fed tightening is what gives you the face wash across asset classes. So that part, I think, I agree with you. I think that Wall Street has a complete bass backwards on how that plays out. They currently say, oh shit, bond yield go down, buy profitless tech. Bond yield go down, buy crypto, buy, they don't, there's like, it's reflexive, of course, and it's got a huge recency bias. But I agree with you. I mean, if shit hits the fan economically the way that we're talking about, the natural outcome would be for the bond market to be knocking on the door, to use your analogy. The long end of the curve would be knocking on the door, saying, this recession is way worse than you thought, faster, and now you're going to turn tail and the curve's going to steepen because the long end goes down and you're in a race with it on the short end to get on board. How fast do you think that one, do you agree with my depiction of that? Because I just said a lot. And actually, one, do you agree with that?
Yeah, yes, I do. I mean, it's always like, that's why you have the policy trap. That's why, in French, I tried to refer to earlier, a bat is called a chauve-souris, which is literally a bald rat. And that's how I think of the central banks as being bald and blind rats. No offense to anyone who's losing follicles too quickly. But yeah, the policy error is that it drips. But you have to be conscious of the drips. When you hear a drip, call a plumber. Don't wait until the water is coming through the ceiling. And sadly, the Feds are it waits until the deluge before it does anything about the plumbing. And again, Bank of England, UK gilts, a gilt market that's gone 1% to 7%. And can I say something? I mean, how dumb this world is. The World Bank believes that Asian GDP growth outside China will be 5% next year. It will be an acceleration on this year. That is their central forecast. It's yeah. And they're all meeting now in Washington. I mean, they are clueless.
Right. No, it's like you called it. Le chauve-souris. Je parle français, moi aussi. I don't think I've ever heard that, ever. The blind bat rats. It is really amazing. It's an amazing thing to think that the economic cycle, no matter what, going back to my point, the part of the job that I hate, which is entertaining all these questions from clients about when that pivot's going to happen and why we go buy all the shit that we just blew up in, that's not the answer. I know what you need, but that's not the answer. That's not the answer to the economic system. And last I checked, the Fed cannot bend and smooth economic gravity. Cycles take a long time to play out, in particular the credit component of this cycle. Last question for me before I turn over. If you have questions for, we have 15 minutes for a Q&A, and I'll take the first one, Hugh, if you don't mind. But my first question for you, and just pop your questions in the queue. The way that this works, Hugh, is that I have to get myself together here and take the ones that are voted the highest, so ostensibly they're good questions. But just as more back to the plumbing and what you and I have these, you alluded to these, the smarter people than I'll ever be inside the market when we talk about gamma squeezes, doom loops. Having traded markets for 23 years, when I look at markets from that perspective, knowing nothing about macro, that makes me shit scared beyond anything else. The mega hedge fund leverage running neutral, the gamma squeezes 1 to 3 days a month. Can you talk about these loops?
Well, I tried to allude to it earlier that recently I've been in conversation with like the smartest minds in volatility. And I think maybe I was on bad form. Maybe I just drank too much tequila the night before when I was talking to Jem Carson. But Jem was very much of the opinion that there is, I believe he was of the opinion, I may be misquoting him, but he thought there was a kind of reflexive gamma loop because volatility as an asset class, like for fixed strike prices, volatility has been catastrophic this year. And like vol funds have been closed at, I believe, at a record rate. That volatility as an asset class has lost money this year, which goes against the grain. And therefore, the strategies adapt, and the most successful in terms of year-to-date gains has been selling puts and selling stocks and running a delta one, neutral delta one. But should there be gap risk to the downside on markets, the convexity on the short put position would lead to would exercise the minds and would require a lot of trading and might feed more and more selling of stocks. On the other hand, I was talking to Ben Eifert, and I'm going to be releasing that conversation with Ben on my podcast on Friday. And he was saying, yeah, he doesn't actually see he doesn't see that kind of lazy institutional error and the convexity loop or the gamma death loop. So if they can't decide, I can't decide. But again, I come back to the notion that this, we've been discussing this for a while. The bond market has been inverted for a while. Bond markets get it right, and so for the smart risk managers, it's a known that next year is going to be horrid. But how many smart risk managers are there? Because we've just gone through a period where heads as a manager, I win. Tails as a manager, I win. You, the client, you the silly sap that has the pension. A, I don't know who you are, and B, you definitely don't win. And that's again
that's bad.
Why the revolution coming.
That's bad. That's the bad part. And I will preemptively thank you for giving people an education, because again, the people for a long time just didn't have access to this. This is free right now. We do that for a reason, so that people can learn something that they're not going to learn otherwise on the bullshit channels. But the first question actually has one of the top voted questions here, Hugh, has to a degree to do with that, because the people get it. They just don't get how it ends. So this question's from RM. Hugh, can we change the fourth turning, or are we doomed for a Fed pivot? Could the Fed choose to pursue a recession and 4% inflation, or Bitcoin maxis right? How exactly would the system break if we don't do QE again?
Did you tell me you were taking the first question, or you were fielding the first question? Do you want me to respond to that?
Yeah, that's for you. Yeah, that's
okay.
Yeah.
Well, again, our debate is always very Federal Reserve centric, and
right.
There are two things: policy prescriptions, which I've been pushing for a while, which is to have a withholding tax on sovereign mercantilist nations trying to leverage up the U.S. Household sector. Like it's essentially, I mean, I liken it to those drug cartels back in the Reagan administration, where they were coming in and supplying white powder into LA and just like making the local population crazy, hysterical. That's what this mercantilist policy has been doing. It's been been putting households on opiates by destroying their economic life. That has to stop, and it's very easy. We stop the manipulation of their currency. It's becoming very pressing as a demand because, like I say, we could be close to them pushing for a devaluation. This year is the weakest year-to-date performance of the renminbi, I think, for a long time. So I would charge them like, you want to own $1 trillion of US Treasury bills? Fine, we're going to charge you 3%. They'll pay it. We kind of confuse. We think they're hedge fund managers. It's a Chinese Communist Party, you know. It's a preservation scheme. They'll pay it 3, make it 4, make it 5. They'll pay it, and then with the funds that you would raise from that. So when the Federal Reserve pivots, okay, it's not the Federal Reserve. It's the U.S. citizen, all of the citizens, which are being asked to bail out essentially those who own assets, which means that the unfortunate or the people who are too young coming into these 4 turning points, everyone has to bail out the asset owners. But what's in it for? You know, it's unfair and unjust. And so I think the US would be well advised to create a sovereign wealth fund specifically for that part of this of the citizenship which doesn't have assets. And so when the Federal Reserve comes in and is buying whatever risk asset to support the price to prevent the bankruptcy of the global financial system, it should be buying those assets at arguably cheap levels, and it should be buying them for the disenfranchised citizens of America.
Now that's an interesting idea I haven't heard before, and as are most things that you come up with. Was not expecting that answer. Here's another question. This is really interesting. I mean, if only because it talks about surfing and hockey in the same sentence. But this is from Rich. Keith often highlights his days playing hockey as having impact on how he coaches us now. I think he's alluding to how, like, I talk about risk management, talk about the process. What are some of the impactful life lessons you've learned, Hugh, from surfing that are applicable for investors, and how you coach your process at Eclectica?
Well, I'm fearful. I like taking lots of risks with rhetoric and with words, and I'm not afraid of making an ass of myself. But I'm very, very conservative when it comes to my financial longevity. And so with regard to surfing, I'm not going to give you any bravado. My surfing, I do daddy surfing, first of all.
Yep.
Which is to say, I'm on a stand-up. I'm on a big longboard. I'm taking waves. I mean, just going for miles is kind of okay for your abs, but it's tedious. But I surf. I surf on a break which has coral, which terrifies me. I even wear little thin shoes because I don't want to touch the damn coral, and I like little waves. So, and that's how I approach investment. So I secured 15 years of tenure as a portfolio manager, as a macro hedge fund manager. And I'm proud of that. That's in dog years, that's a long,
that's a lot.
A lot, dog hedge fund years. And I got there because I was prepared to be wrong. I was not fearful of being wrong because I knew the cost of being wrong, that I was always seeking. Remember, I was trying to create or conceive of a contentious narrative, that could go on and become the accepted belief system within 2 years. And so whatever I was buying was deemed to be impossible, and therefore was kind of given away. It was cheap. Mm-hmm. And yet if I was right, boom, convex returns. But I could afford to be wrong. Now, what that meant was I was mostly wrong. Yeah, I was mostly wrong. But when I was right, I was really right. So that's kind of, if you will, that's my parable or parallel with my pathetic surfing.
I like that. You often find that people, there's similarities in terms of how they live their life and how they, work through this constant journey of trying to run money and risk manage it. It's not, neither are easy, neither tasks. But on that, if you were to just take, maybe you've already answered it, is the most contentious position right now where you'd have the most asymmetric setup with relatively low risk buying treasury bonds? Or is it something else?
Would be buying, would be a Delta One treasury purchase. you might be looking at strikes in terms of the euro dollar market, in terms of looking for a capitulation. You'd be going against the wisdom of the treasury market. So I think it's got the Fed ultimately cutting rates round about. You know this better than me, Keith. Is it summer of 23 or where are we? This is 22. Yeah, summer 23. And so you might be looking at the Fed being at 75 basis points for Christmas 23. I think that would be very much below where the Eurodollar curve is. The thing about that, however, is everything in fixed income vol is elevated. Mm-hmm. It is elevated, but it's not trading at wides. And I kind of, again, I've got Jem Carson in my head. It's telling me, buy kind of illiquid, which is like buy out of the money and buy out of time type of, like buy a long way out, and speculate in that sense. So that would be something. I still maintain that the Chinese FX and buying volatility by shorting there, and by just having some like plain vanilla options. These are tradable. These are available to most people. Realized, of course, is trading below implied, but realized is not that high. So, which is to say, the options are they're not excessively expensive. So there are opportunities, and of course, with all of these things, and being a hedge fund manager, I kind of have a diversity. I'd be kissing girls at the same time as I'd be praying to the priest.
Well, we Irish guys would never do such a thing. So, how about gold?
Well, do you know, I'm beginning to get a sensation about gold. First, okay, by matter of introduction, my first calendar year as the hedge fund manager in 2003, I made 50%. And I made that from gold. It was not simple. I think at one point I was down 20% on the year, and I thought I was not going to make it. The Bank of England, remember them? They were selling gold, and I was buying it. So I've got form. Secondly,
did we lose him? Somehow we lost him. Wow. Right when he was going to tell us what he was going to do with gold. He came back.
Did I break there?
Oh, there he came back.
Yeah.
Thank God.
So I was going to say that the correlation of gold to real US rates is interesting.
Yeah.
And I'm beginning to think that have US real rates. I'm looking at 5-year real rates using break evens. They touched about 2% positive. I think real rates have to be flat or negative to keep this world of debt and leverage alive. And so I'm beginning to think if real 5-year rates have peaked, then it would be the time to consider gold again. But for me, in terms of survival and my surfing, I look for a wave, and I look for price momentum, upwards momentum, and gold doesn't quite have that yet, but I'm intrigued.
No, it doesn't have it yet, but the first sign of a potential wave is identifying where those higher lows are in the break. So it's interesting. It is uniquely tied and almost explicitly tied to real rates. And if your view is that inflation is yesterday's news, which sounds like you and I agree on, that at some point, if you were to have a proper quad 4 deflation, not disinflation, deflation, 100% of the time gold pays out in that with a rising dollar, I might add, which is that's more proper quad 4 deflation. So that's an interesting one. I'm with you. I'm waiting and watching on that, but
be wary, because remember in 2008, capitulation, forced selling. Oof. Gold I think went from 960 to like 560. Real rates surged to 4%, which was crazy. They were 4% for like a week, But so you might have to navigate a lot of volatility if you were to enter a gold position. But nevertheless, if we're right on that thesis with real rates peaking, then gold, I think, would ultimately prove rewarding.
That makes sense to me. Well, the conversation did too, and I really appreciate. Unfortunately, we're out of time. I know people could listen to you for a long, long time. They can listen to you, of course, on your podcast, correct?
Yeah, indeed. If you look up Hugh Hendry, I call it the Asset Capitalist, but I think the Apple podcast platform insists on my name, and then we do it on YouTube, Hugh Hendry Official, and of course Hendry_Hugh on Twitter. I was out castigating that we had a Yale professor in the Financial Times today.
Oh boy,
nonsense about how gas is like European gas is a buyer's market. I mean, who is this guy and why is he writing fantasy as fact? So you'll find me on Twitter making those allegations.
Well, that's awesome, man. And keep being yourself. Don't be afraid to make mistakes. That's a great point of advice. And keep living the life, man. You look like you're happy, and it was good to see you. Thanks for making the time.
Thank you, Keith. Thank you very much.
He is Hugh Hendry. Wow, awesome. Up next, Mike Green. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.